Right. Right now we want to talk about IFRS 15, International Financial Reporting Standard 15, revenue from contracts with customers. Right. The standard IFRS 15 was issued in May 2014. It is mandatory for all accounting periods beginning on or after 1 January 2018, with earlier adoption permitted. So, which means by January 2018, we should all organizations should have started using the IFRS 15. So, IFRS 15 is a combination of IAS 18, which was revenue, and IAS 11, which is construction contracts. So we are saying it comes to replace these two standards and become one, right? Interpretations, or as well as other interpretations from the International Financial Reporting Interpretations Committee, which is 13, 15, and 18, or the SIC 31. Noting that the SIC, which was the pre-2003 title of what are now called the FRICs. Right, revenue. So what is revenue? Revenue is the gross inflow of economic benefits during the period arising in the course of the ordinary activities of an entity. So we are saying any gross inflow within the organization is recognized as revenue, but within the period arising due to any ordinary activities of the organization. So which means if you're making general sales, those are recognized as revenue. That is why we are saying ordinary activities. Right. So what are the key principles of recognizing revenue? How do we recognize revenue? The primary issue in accounting for revenue is determining when to recognize revenue. So there's always a problem when recognizing revenue, because some people, they want to recognize revenue maybe when they receive a prepayment. Some people want to recognize revenue when the cash flow comes in, even if the transaction happened maybe 2 years ago. Some people want to recognize revenue when the transaction is happening. So there is that confusion. So that is why we want to classify how to recognize revenue, when to recognize revenue, and what do we deem as revenue. So revenue is recognized when an entity satisfies a performance obligation by transferring a promised good or service to a customer. However, a good or a service is only considered transferred when the customer obtains control of that good or service. So we are saying when we give the customer a good, that is when we recognize revenue, right, of maybe something that we are selling to the customer, or when we deliver on a promise of a service, that is when we recognize the revenue. Then there's, however, we're saying a good or service is only considered transferred when the customer obtains control of the good and services. But usually we recognize revenue when it meets the following criteria. A contract has been agreed between parties. This may be oral or in writing. So when we recognize a contract, there's a contract, right? And we recognize the contract, whether fulfilled or not at that present moment, it is considered to be revenue. When there are goods, the value of the goods and services has been established. We are selling a product, then we agree on the cost or the value of that product or the service. We agree on the cost of the service. That's when we recognize that this is revenue. The product or service has been provided to the buyer and control has been transferred. So we are saying even when the buyer, before the payment happens, right, and we have offered maybe a service of maybe internet service. We're an internet service provider. We offer internet to the customer, but the customer is not yet made payment. But just offering that service, and when the customer controls that internet service, we are saying we are going to recognize that as revenue. And the buyer is indicated willingness to hand over cash or other assets in the settlement. So we recognize as a provision of a sale or a goods as revenue when the buyer is indicated that he or she is willing to make payment on the goods or services to be provided, or the payment might be in cash, or the payment might be an exchange of maybe payment through the settlement of an asset. Right. These are the 5 steps of recognition of revenue. So for us to recognize revenue, we're going to use the following 5 steps. Number 1, identify the contract with the customer. Identify the contract with the customer. A contract is an agreement between the parties. It need not to be in writing, as a valid contract can be oral or implied. The key requirements are that the contract has commercial substance, identifies each party's rights, and makes clear the payment terms. It must be probable that the consideration will be collected. So we are saying we recognize revenue, 1, when we have identified the contract with the customer. So in this contract, we are saying 2 parties should be in agreement, and 2 parties should be one should be willing to sell the good, one should be willing to part with money, or to part with a certain settlement obligation, right? So that is when we recognize a contract. And at the same time, in the contract, it should be stated that the seller is willing to receive payment and the buyer is willing to make payment. That is how we recognize a contract, and this is going to assist us in terms of recognizing revenue. Then number 2, identifying the performance obligation or performance obligations. This refers to whatever the seller is obliged to do under the contract, right? So what type of performance does it entail? For example, our contract is the example that we used about providing internet. The contract is between us and someone who needs internet. So we show that we are going to provide internet. How we are going to provide internet should be stated in the contract. So we should, in the contract, or before revenue can be recognized, there should be identification of our duty as the seller and the duty of the buyer within the contract. So this refers to whatever the seller is obliged to do under the contract. The performance obligation may be single or multiple depending on the situation. A straightforward retail sale of goods is an example of a single obligation. Once the seller provides the goods to the buyer, it has satisfied its performance obligation. Sometimes a contract may have multiple performance obligations. An example here is a seller that agrees to supply and install a heating system for a customer. The supply of the goods is one deliverable. The installation of the system is another. Each portion capable of being sold separately must be identified. As you can see in that example, the second example, we are saying the customer needs some heating system, right? Supplying the air conditioning system is one. Then how the system is going to work is another. So all those can be classified as different forms of recognizing revenue, or it can be a multiple obligation. Then number 3, determining the transaction price. Normally the agreed price is clear from the agreement. It should be taken to be the fair value, right? When you're talking about fair value, we are saying what is the market price of the product, or what is the agreed price at the transaction date. The price should be considered net of VAT, trade discounts and rebates, but it is not net of settlement discounts. So there we are saying, when you are pricing, when you are recognizing revenue, the price should it should not have the effect of any taxation on it or any discounts. So it should be the price. If we are saying our internet costs $500, the $500 should not be inclusive of VAT. It should come now, the VAT, the 15% VAT. Afterwards, we've recognized the price, making maybe the seller, the buyer is going to pay at least maybe $575 after. So that is how we determine the transaction price. Number 4, allocate transaction price to performance obligations. This step is only relevant if multiple deliveries exist in the contract. If there is only one deliverable, the entire price is allocated to that. If there are multiple deliverables, the transaction price is allocated to the deliverables in the ratio of the standalone selling price of each individual deliverable is the contract date. So we are saying there, in terms of our example of maybe internet, right? Providing internet, providing the modem, one price, providing the internet service, another price. So we are saying you should allocate transaction price to the performance. So if we are going to provide the modem to the customer, we're going to charge a standalone price that is different from providing the actual internet to the customer. Then number 5, which is the last, how to recognize revenue, the last step. Recognize revenue when the performance obligation is satisfied. So we are saying when our customer is satisfied with the goods that we have provided or the service that we have provided. For example, if the customer is satisfied that the modem in the provision of internet, the modem is working properly, and internet that is being received without any interruptions, then we are saying the obligation is now complete. So we can now recognize the revenue. But in certain circumstances, maybe they can be returns. So if in the circumstances that they are returns, we are not going to recognize that revenue because they are returns or there are complications with the supply of the service. Right, how do we measure revenue? Revenue shall be measured at fair value of the consideration received or receivable. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Right? Fair value, for fair value, more information, I will refer you to IFRS 13, but we are saying we measure revenue at the transaction date or at how we would have agreed to the price between the buyer and the seller. That is how we measure our revenue. Right, with me there, I have an example of a simple transaction on recognizing revenue. Milton Limited, a motor dealer, sold a vehicle to a customer on 14 November 2017. The contract showed an agreed price of 30,000 and a delivery date of 3 January 2018. The customer paid a 20% non-refundable deposit on 14 November 2017. The vehicle was delivered on 10 January 2018, and the balance due of 24,000 was paid by the customer on that date. Required advice showing relevant journal entries how the above transaction should be recognized in Milton's financial statements for the year ended 31 December 2017 and 2018. How do we solve this transaction? We go back to the 5 steps of recognizing revenue. Step number 1, is the contract clear? Yes, the contract is clear. Number 2, the performance obligation. Is it clear? Yes, it's clear. Milton has delivered the motor vehicle, right? Step number 3, what is our transaction price? It is $30,000. The price is there of the motor vehicle. Step 4, there is only one performance obligation. It's the entire transaction price is allocated to that. So the performance obligation, is it one or multiple? So this one is only one. The supply of a motor vehicle at $30,000 at that set date, right? Number 5, the performance obligation is satisfied as of the 10th of January 2018 when the vehicle was delivered. Hence, Milton will recognize that as revenue on the date. So we are saying before even the buyer paid the deposit, right? The buyer paid the full agreed price, right? way before the vehicle was delivered. We are going only to recognize the revenue when the vehicle was finally delivered and when the customer is happy with the motor vehicle. Thank you.